I'm delighted to see that our third speaker has arrived on time, and that is Dimitrios Tsomocos. And if he's sticking to the title on the program, then it's as you have in front of you, as Milton Friedman talked as our central.
Thank the organizers for this invitation. In fact, it's a little bit peculiar that a person like me talks about Friedman, because the ones of you that know my background, I am a Yale product. Throughout my studies as an undergraduate, graduate, postgraduate, I've taken courses with Tobin, Bill Norhaus, and the rest. So one might expect to replicate one way or the other our keynote speech of yesterday about the influence of Milton Friedman to economics in Britain specifically. However, I'll follow a different route. In fact, I will argue that the contributions of Milton Friedman, both in policy and economics, were non-trivial. In fact, I will argue that basically he elevated economic thinking and economic methodological research in macroeconomics, and it brought it to its next higher level. And that level changed once and for all the way that we conduct macroeconomic analysis. And I will emphasize, and I'll try to mimic, I'm sure I will fail, his famous presidential address in 1968, whereby that address, despite the possible flaws that it may or may not possess, it was an excellent piece of general equilibrium analysis without a single equation. So basically, what Milton Friedman brought to macroeconomics was an explicit statement of the need to introduce micro-foundations and analysis for first principles to the then otherwise ad hoc, if you will, partial equilibrium analysis that the standard Keynesian economics was offering up until that time. One realizes that after that paper, an entire literature was initiated, not only in Chicago, that was his home place, but also in the Boston, New York, Princeton axis, where, if you will, his intellectual opponents were. And then macroeconomics after that paper was never the same. Then you had Lucas, you had Gramont, you had Bewley, Ayagari, you had all of these people that were doing micro-foundations to macroeconomics. Why? We knew from Walras and Arrow and Debray in the 50s, we knew quite well what was happening in general equilibrium. But Friedman was the one who first initiated or pointed out the importance of bringing liquidity into general equilibrium. Basically, by bringing liquidity and money from general equilibrium, that was the missing step to start doing macroeconomics from first principles and try to have models that will be, if you will, more easily addressed and, above all, assessed. Because we could generate benchmark analysis as we usually do in microeconomics, and basically he opened the way to do general equilibrium, dynamic, stochastic general equilibrium analysis, infinite horizon economics. If you will, he brought extra emphasis on the overlapping generation literature, that at that point it was a literature that was very esoteric and only mathematical economists were dealing with. So I'll try basically to outline how one can go introducing liquidity into general equilibrium, and the other side of the coin, which is default. Because monetary economics, macroeconomics, without the monetary sector, basically is like performing an operation in a hospital whereby the patient is absent from the operating table. Likewise, default liquidity without the assessment and the introduction of default in the analysis, basically it is what theologians might mention that sin is regrettable, however, unfortunately, ever present in life. There was, when we talk about liquidity and money, the next natural question, the next minimal institution, if you will, is to introduce default. Because credit risk affects the ease with which economic agents and institutions can raise funds, and market liquidity can exacerbate solvency constraints and convert illiquidity to insolvency. In fact, it's very interesting. I was, at the time, 2000, when Friedman passed away, it so happened I was in the US, I opened the New York Times. The last op-ed that Friedman wrote was the date he passed away, comparing basically the financial crisis of 1929, 1997, and 1987, arguing that the efficient treatment of the monetary policy and the monetary aggregates ameliorated the adverse effects of these three crises. And this is thanks to what Milton Friedman, who started as a macroeconomist, yet appreciated the importance of feedback mechanisms and institutional constraints. And above all, frictions. And the ones who do monetary economics and macroeconomics after the global financial crisis, basically, everybody basically is dealing with financial frictions. However, one needs, if you will, the benchmark case that Arthur Debré and Friedman formulated so successfully. So, any model that tries to analyze monetary policy, financial fragility, and their interaction should have, as Friedman would argue, with his permanent income hypothesis, intertemporal decision making. So the static modeling that macro was so bewildered all the way till the late 60s, Friedman and subsequently Modigliani tried to alter and introduce the dynamic aspects of macroeconomic analysis. Moreover, uncertainty is an integral part of any attempt to properly model monetary policy, financial stability, and their interaction. In fact, frictions that are entailed by uncertainty, like financial markets incompleteness, whereby not all risks, aggregate or individual risks, can be properly insured, is an integral part of successful analysis. So the incomplete risk sharing as financial stability or instability is testimony to that, affect welfare. In fact, Friedman, who emphasized agent heterogeneity in a way, without explicitly stating, had the Stiglitz-Newberry intuition in mind, that equilibria, when we move away from the benchmark case of fully fledged complete markets, moneyless, institutional general equilibrium, may start being not only inefficient in the sense, if you correct for the financial frictions, obviously you move closer to Pareto optimality, but it may be constrained Pareto optimal. In other words, you may not be able to arrive at the second best, but at the third best, whereby policy, correct, optimal policy is warranted. So, if you see general equilibrium in a more analytically precise and heterogeneous way with financial frictions, then general equilibrium is what warrants the correct policy design and implementation. And Friedman and his, if you will, his successors were fully aware of that. Last but not least, now to bring back the other side of the coin, Irving Fisher had emphasized default. In fact, his whole Fisherian debt deflation theory was the importance of default. So, as long as in an analytically coherent way, where default is being introduced as an active reality in a model, but not as an out of equilibrium possibility, but in equilibrium and compatible with the orderly function of markets, then you are in a position to make a contemporaneous analysis of both monetary policy and financial instability. A model that possesses, in general equilibrium within complete markets, agent heterogeneity makes obvious that the wealth effects matter, that the quantity theory of money that Friedman so painstakingly emphasized in the short run is non-trivial, in the sense that monetary variables and velocity variables in the form of securitization of new financial security design affect both prices and quantities. I think, and as you can see in his op-ed, this idea that money affects only prices is an idea that was promoted by Friedman only in the benchmark cases. He was fully aware of frictions and financial frictions that exist in the economy, thereby he was fully aware that policy in certain cases matters. But what he emphasized we have to be clear which and how we model frictions. Something that up until the presidential address of 1968 existed, people were aware of, but it was not very analytically and precisely pointed out in the literature. Then, as long as you have liquidity and default to be compatible with the orderly function of markets, not as if default is something that's isomorphic to a financial catastrophe or a bank run a la Diamond Divvy, then the next logical necessity is to define financial fragility. And financial fragility, for better or worse, unlike inflation targetry, unlike monetary policy, cannot be in one-dimensional variable. It has to be a variable that pertains to financial intermediation, in other words, commercial banking profitability, as well as aggregate default. So it's the combination, the constellation of the interaction of two variables, namely default and default and bank profitability, that are commensurate and they precipitate in financially unstable regimes, rather than to bona fide recessions or inefficient insolvency and falling over commercial banks due to inefficient functions. Then one starts proceeding with such a model that has heterogeneity in complete markets, agent heterogeneity, default, liquidity, and subsequently wealth effects that have redistributive importance. One can see that the central bank controls the overall liquidity of the economy, and the overall liquidity of the economy determines liquidity premia as well as credit risk premia that emerge from endogenous default. And both of the liquidity as well as default and credit risk premia affect the determination of interest rates, as it was obvious during the global financial crisis. Moreover, the heterogeneity and the fact that we have active default in equilibrium also generates monetary policy non-neutrality in the short run, in the sense that monetary aggregates and interest rates determine both prices as well as quantity. So it is the friction within a general equilibrium framework that destroys, if you will, or prevents the classical dichotomy to emerge and dominate the short run. Finally, the famous Fisher effect, another effect that Friedman emphasized and people were aware in his times, namely that the nominal interest rates, it is equal to the real rate of interest plus the expected rate of inflation in the short run as well as the long run. So, basically, one introducing and incorporating in a fully fledged, closed economic models liquidity and default, you can see how agents with more investment opportunities, more degrees of freedom, can transfer the externality of adverse nominal shocks, capital shocks or liquidity shocks to less flexible agents. One can start talking about capital requirements as well as liquidity requirements, their complementarities as well as their substitutabilities when default is present, because then you have and the short term and the long term decisions with respect to money and default. Third, and more importantly, one can see an improvement such as productivity shocks, which concentrated in one part of the economy, not necessarily improving the overall welfare of the economy. The last two insights are very important with respect to constraint Pareto suboptimality, and they relate to the innovative feature of the model incorporating heterogeneous agents, financial intermediation, and wealth effects. Therefore, emphasizing what Friedman always emphasized, that the price mechanism can produce pecuniary externalities without necessarily resorting to the adhocery of fixing prices or fixing wages and so on and so forth. Pecuniary externalities is an outcome of the well-functioning of the price mechanism in a world with multiple commodities. And multiple commodities was something that was central in the way that Friedman was viewing economics. Now, when you try to move to dynamic models, like the dynamic stochastic general equilibrium models, with default, one has to be worried and one needs to be careful how not to prevent default altogether in equilibrium. We have literature that purportedly is inspired by the rationale of the neoclassical tradition of Chicago, whereby the possibility of default exists, but it never materializes in equilibrium. The question is to have the friction that bind and they have an important effect in equilibrium. The last bit of my presentation is how one might do macroprudential policy, because the new, basically, innovation after the global financial policy is the advent of macroprudential policy, which prima facie is orthogonal to monetary policy. However, at a closer look, macroprudential policy, it is a form of intervening at a different point, a different portion of the transmission mechanism of monetary policy. Therefore, one has to comprehensively and simultaneously consider macroprudential policy and monetary policy. And the two guiding principles of macroprudential policy should be to be imperative to start with a general model where the financial system tries to encapsulate all the fundamental functions of the commercial banking system, namely liquidity provision, risk sharing, and delegated monitoring. Second, intermediaries should operate in an environment where the savers who use them are forward-looking and will possess rational expectation, and the crisis the intermediaries face adjust to the regulatory environment. In other words, one of the soft underbellies of the price mechanism is to have results that depend on preferences and open the door to behavioral economics and behavioral finance. In a way, as the late Steve Ross would argue, behavioral finance and behavioral economics, it's kind of an illness of the young generation, because they don't want to use the classical principles and fight to write an argument for 6, 7, or 8 months, but they want an easy paper within 2 weeks by playing around with preferences and various other behavioral assumptions. The less we depend on preferences, the more robust and the stronger are our results. Now, basically, if one goes Along this way, using the concept of pecuniary externalities, one can find portfolio allocations and real allocation that the market mechanism produces, contrasting with what the social planner recommends, and then find the positive policy measures that can improve the welfare of borrowers, savers, the production and the consumption set of the economy. In order to conclude, I just want to emphasize that unlike what is the common perception that Friedman was not, and his successor to a bigger or lesser extent, was not aware of Keynesian economics, of wealth effects, this is not true, it is false. In fact, he contributed to, if you will, Keynesian economics or general equilibrium analysis financial frictions more than most of our colleagues will be willing to accept. Because he was fully aware of Keynesian economics, but he wanted to make a methodological breakthrough to have solid foundations upon which one can build and develop arguments. Thank you very much.